UK mortgage crisis. The mortgage market is in shambles as a speculation of Bank of England raising interest rates significantly increases. Nearly a million facing an increase of at least £500 a month. Around 200,000 will see their bills rise by £100,000 or more. Up to 650,000 households at risk of defaulting by end of year. The Bank of England warned that the sharp increase in housing costs means hundreds of thousands of families may struggle to pay their mortgages. Around 4.4 million mortgage holders have already seen increases in their mortgage costs since the end of 2021, when the Bank of England began raising interest rates from historic low of 0.1%. A further 3.8 million households are expected to remortgage before the end of 2026 and will face a sharp jump in cost. The Bank of England has released its twice-yearly financial stability report, setting out the health of UK's banking system and its ability to withstand shocks. The Bank of England warned that some 4 million households will face a sharp increase in mortgage costs, with the average borrower paying almost £3,000 a year more. The assessment in the central bank's financial stability report underscored the strength from the quickest series of rate rises in 3 decades. The action is meant to slow the economy and rein in inflation, but will bring real pain for consumers already coping with the tightest squeeze in living standards in generations. The Bank of England said that a typical household rolling off a fixed deal in the second half of 2023 face a £220 per month increase in their mortgage costs based on current rates. By the end of 2026, about 1 million households will have seen their payment to go up by more than £500 a month. This assumes they refinance at the same maturity, but about 15% of mortgage holders have extended the length of their loans. By the end of 2026, around 200,000 households will see their monthly mortgage bill rise by £100,000 or more. The warning comes after Moneyfacts revealed that the average rate for fixed 2-year home loans rose to 6.69%, the highest since August 2008. The pain for homeowners could get even worse as the Bank of England is forced to ramp up interest rate to stamp out inflation that has proven surprisingly sticky. Currently, markets are pricing in a peak bank rate of almost 6.5%. The Bank of England also warned that an exodus of buy-to-let landlords facing high mortgage costs threatened to hit house prices as many consider selling their properties. Furthermore, the financial stability report said falling profitability could, in principle, cause landlords to sell their property investments and exit the buy-to-let market. If this were to happen in large enough volumes, it could put downward pressure on house prices. Some landlords are more vulnerable after taking out interest-only mortgage deals, and many are hiking rents to cover their high costs. The Bank of England said landlords who are set to face a £275 per month hike in monthly payments on average will likely put up rents to offset the blow. UK private rents already rose 5% in the year to May. The impact of the high mortgage cost has been delayed by a huge shift in the UK from a variable rate mortgage to fixed rate deals, typically lasting 2 or 5 years standards. While the mortgage arrears remains low by historical standards, the Bank of England's Financial Policy Committee said they are increasing and that it will take time for the full impact of higher interest rates to come through. The amount of all UK households will have to pay out on mortgage costs will climb up to 8% of their post-tax income by 2026, up from 6.2%. The Bank of England says that around half of mortgage holders, 4.5 million, have already rolled out onto new deals since the start of its hiking cycle in December 2021. Nationwide Building Society said house prices slipped 3.5% in June compared to a year earlier, but economists expect the downturn to worsen after the recent surge in mortgage rates. Research by the National Institute of Economic and Social Research recently estimated that the Bank of England's recent 50 basis point hike would see 1.2 million UK households, 4% of households nationwide, run out of saving by the end of the year because of higher mortgage prepayments. The housing prices is plummeting an alarming rate since 2009. As the cost of mortgage rises dramatically, individuals are unable to refinance the mortgage and putting their houses for sale. This will put more downward pressure on house prices. As a result, UK housing crash is imminent. As the job of Bank of England is not yet complete, the peak for interest rate is yet come. Hence, the housing market crash is inevitable. As a result of rising Bank of England rate makes housing mortgage more expensive with each passing day, and the UK may face a mortgage exodus and housing crisis next year. Thank you so much for watching. Please consider like and subscribe my channel.